What if the Great Depression of 1929 was just a dress rehearsal? In the next few minutes, I'm going to show you why a cyclical economic model, one that has been studied for over a century, suggests that in 2026 we could face a financial crisis that dwarfs not only 1929 but also 2008. This is not just a random guess. It is a conclusion based on a convergence of historical patterns and modern data points that most people are completely unaware of. The mainstream media might tell you the economy is sound, political leaders might point to superficial signs of strength, but they are missing the bigger picture. They are ignoring the powerful forces building just beneath the surface. We are sitting on a time bomb of debt and speculation so colossal that its eventual detonation seems less a matter of if, but when. And the clock is ticking faster than anyone is willing to admit. Stay with me, because what I am about to reveal is not just a warning. It is a roadmap to understanding the precipice on which we stand. To get a handle on the sheer scale of the danger we face, you have to look past the daily headlines and focus on one thing: debt. The numbers are so large they are almost impossible to process. As of late 2025, the total global debt, that is everything owed by governments, corporations, and individuals, has exploded. While precise, real-time figures are hard to nail down. Recent reports from institutions like the International Monetary Fund and the Institute of International Finance put the figure somewhere between $251 trillion and $320 trillion. This number represents well over 235% of the entire global economy. In other words, for every dollar of economic value created in the world, there are more than $2.35 of debt dragging behind it. This is the definition of an unsustainable system. But to truly grasp the danger, we have to break it down. This is not just one big pile of debt. It is a series of interconnected powder kegs, and each one has a lit fuse. First, government debt. This is what nations borrow to fund everything from roads to social programs. In the United States, the situation is spiraling. U.S. federal debt held by the public is already hovering around 100% of its GDP. For perspective, before the 1929 crash, the U.S. national debt-to-GDP ratio was about 16%. Today's level is more than 6 times higher. We are in completely uncharted territory. The Congressional Budget Office, or CBO, projects this debt could surge to a staggering 156% of GDP by 2055 under current laws. And it is not just the U.S. In 2025, Japan's gross government debt is forecast to be around 230% to 242% of its GDP. Many European nations are also in deep. Italy's debt is well over 130% of its GDP, and France's is hovering in the 110-114% range. These are not just numbers on a spreadsheet. This is the foundation of our global financial system, and it is cracking under the strain. But governments are only one piece of the puzzle. The second powder keg is corporate debt. Was the era of rock-bottom interest rates that followed the 2008 crisis, companies around the world went on a borrowing binge. Today, the U.S. corporate bond market alone stands at over $11 trillion. Many of these companies are what economists call zombie firms. They do not generate enough profit to even cover their interest payments. They only survive by taking on new debt to pay off the old. They are the walking dead of the corporate world, and when interest rates rise or the economy slows, they will be the first to fall, triggering a domino effect of bankruptcies and layoffs. The commercial real estate sector is a particularly bright red flag with experts like Warren Buffett, his late partner Charlie Munger, having warned of a coming crisis due to high vacancies and the struggle to refinance loans at much higher interest rates. The third, and most personal powder keg, is household debt. This is your mortgage, your car loan, your student debt, your credit card balance. Globally, this figure has swelled to tens of trillions of dollars. In the United States alone, household debt recently climbed to a new record of over $18.5 trillion. We have been encouraged to live beyond our means, fueled by easy credit, and now the insidious rise of buy now, pay later schemes. These services are just a new, tech-friendly face on an old, dangerous habit, borrowing from the future to pay for the present. Housing affordability has plunged to its lowest levels in a generation. Reflecting this, the average age of a first-time homebuyer in the U.S. has climbed to a record high of 38, a stark figure when compared to the late 20s in the 1980s. So we have governments, corporations, and households all drowning in a sea of red ink. Separately, each situation is a cause for concern. Together, they represent a systemic vulnerability on an unprecedented scale. Unlike 1929, today's financial system is a tightly woven web of global interdependence. A crisis that starts in one market can, within hours, trigger panic on the other side of the world. This is not the debt bomb of the 1920s. This is something far larger, far more complex, and far more dangerous. And it is set to collide with a historical cycle that has been ticking away, largely ignored, for over 200 years. So why 2026? What makes that year the focal point? The answer, according to some analysts, lies in a powerful, yet often overlooked economic theory, the 18-year real estate cycle. This is not some fringe idea from the internet. It is a model based on centuries of data, championed by the British economist Fred Harrison. Harrison's research, which covers hundreds of years of land prices, uncovered a recurring pattern, an economic rhythm that beats with remarkable consistency. Proponents say the cycle lasts approximately 18 years and is a primary driver of the boom-bust phenomenon. They point to its track record. Harrison famously used this model to publicly predict the property crash of the early 1990s, years before it happened. Then, as early as 1997, he again used the cycle to warn of the coming crash around 2007-2008, a prediction detailed in his 2005 book, Boom Bust: House Prices, Banking, and the Depression of 2010. He may have been off on the subtitle's timing, but he nailed the event itself, long before most on Wall Street saw it coming. So how does this cycle work? It is elegantly simple. The 18-year period is typically broken into distinct phases. After a major crash, like 2008, the cycle begins again. First, there are about 7 years of slow, steady recovery. Think of the period from roughly 2009 to 2016. Confidence slowly returns, and prices begin to creep up. Next comes another 7 years of a stronger boom. This is where confidence turns into overconfidence. The media runs stories about real estate booms. People start to believe prices only go up, and speculation takes hold. This phase would correspond to the period from about 2016 to the present. But the most critical part is the final act, a 2-year period of peak euphoria known as the winner's curse. This is when the market goes vertical. Speculation becomes rampant, lending standards are relaxed, and prices disconnect from reality. It is the last frenzied rush before the fall. According to Harrison's model, the cycle that began after the 2008 crash is due to reach this explosive peak in late 2025 and early 2026, before tipping into a catastrophic crash. Now, some argue the COVID-19 pandemic broke the cycle. Harrison argues the opposite. The trillions in government stimulus supercharged it. In 2019, right on schedule for a brief mid-cycle dip, the housing market was showing signs of weakness, but the flood of pandemic money poured gasoline on the fire. In Harrison's view, we essentially banked the explosive gains of the winner's curse phase early. This did not stop the cycle. It just compressed the timeline and made the final peak even more precarious. This theory provides a framework, a historical clock. It suggests that booms and busts are not random, but are driven by a predictable sequence of human behavior centered around the most fundamental asset of all, land. As societies grow, land values rise, creating a powerful incentive for speculation. People and corporations borrow heavily to buy property, not for its use, but because they expect the price to keep going up. This drives prices higher, creating a self-reinforcing bubble. Banks, hungry for profit, extend more and more credit against this rising collateral. Eventually, prices get so high that the credit dries up, the speculation stops, and the bubble bursts. The 18-year cycle is the chronicle of this recurring human drama. It is a pattern that followers claim has pinpointed major crashes for generations. When you combine the reality of our global debt supercycle with the historical blueprint of the 18-year real estate cycle, the picture becomes terrifyingly clear. We have a system loaded with an unprecedented amount of explosive material, the debt, and a historical timer that, some say, is ticking down to detonation. This is the convergence that the mainstream fails to see, looking at quarterly reports while missing the deep underlying rhythm of the market. A rhythm that now appears to be reaching its final thunderous crescendo. Every time a crash warning is issued, you hear the same tired refrain. This time is different. They say the system is safer, that we have more regulations. They said it before 2000. They said it before 2008. And they are saying it now. But they are missing the point. The mechanics may change, but the underlying human behaviors of greed and fear and the destructive power of leverage are timeless. To understand why a modern crash has the potential to dwarf 1929, we need to look at the anatomy of that first great crash and hold it up as a mirror to our own time. The Roaring Twenties were, much like our own era, a time of breathtaking innovation and wild financial speculation. Radio was the disruptive technology of its day, much like AI is today. RCA was the NVIDIA of 1928, a stock whose price seemed to defy gravity. But this optimism was built on a foundation of sand held together by one key ingredient, leverage. The key mechanism was called buying on margin. In 1929, an ordinary investor could buy 100 worth of stock with as little as $10 of their own cash. The broker lent them the other $90. On the way up, it was magic. If your stock gained just 10%, you doubled your money. This is what fueled the mania. The legendary story is that Joseph Kennedy knew it was time to sell when his shoe shine boy started giving him stock tips. a sign that speculation had reached every corner of society. By October 1929, the amount of money borrowed to buy stocks had surged to a staggering $8.5 billion. Here is the most crucial part. Leverage cuts both ways. That 10-to-1 leverage meant that a 10% loss would wipe you out completely. When the market started to fall, brokers issued margin calls, demanding more cash. But most people did not have it, so brokers forcibly sold their clients' stocks to recoup their loans. This created a death spiral. Falling prices triggered margin calls, which triggered forced selling, which pushed prices down further, triggering more margin calls. It was a self-perpetuating avalanche. On Black Monday, the Dow fell nearly 13%. On Black Tuesday, another 12%. In just a few weeks, the market lost a third of its value. By 1932, it had lost 89%. Fortunes were annihilated, banks collapsed, and the real economy plunged into the Great Depression. Now, let us turn the mirror to today. The apologists will tell you that margin rules are stricter, and they are. But this ignores the new, more sophisticated, and far more massive forms of leverage built into our system. Let us start with a direct comparison. Investor margin debt. While the specific numbers fluctuate, data from FINRA has shown recent spikes in margin debt that mirror previous market tops. There is a strong historical correlation that is hard to ignore. Major peaks in margin debt relative to the market in 2000 before the dot-com bust, in 2007 before the financial crisis, and again in 2021 before the 2022 correction, have been followed by devastating declines. This is the modern echo of 1929's margin problem, but on a scale that is orders of magnitude larger in dollar terms. But today's leverage goes far beyond simple margin accounts. The real hidden debt bomb is in the corporate world. Remember those zombie companies? They are kept alive by a constant flow of cheap credit. This is a form of systemic leverage. When these companies can no longer roll over their debt, they will be forced to liquidate assets and lay off workers, sending shockwaves through the system, much like the margin calls of 1929. And then there's the consumer. The buy now, pay later phenomenon is just margin lending for everyday life. It encourages people to take on debt for consumption, creating an illusion of prosperity. It pulls future demand into the present, leaving a vacuum when the credit finally stops. So let us put it all together. The U.S. national debt to GDP ratio is more than 6 times what it was in 1929. Investor margin debt has shown alarming spikes. Corporate and household debt levels have reached astronomical heights, with no historical precedent. The powder keg of 1929 was an $8.5 billion margin debt problem, mostly confined to the U.S. stock market. The powder keg today is a multi-$100 trillion global debt problem, woven into every corner of our economy. The fundamental structure of the bomb is the same. It is built on the belief that debt can expand forever and that prices will always rise to validate it. The history of 1929 is the final warning that this belief is a fatal delusion. The coming crash is not a question of a different mechanism. It is a question of a vastly different scale. The convergence of the debt supercycle and the 18-year real estate cycle is not just pointing towards a recession. It is pointing towards something far more profound, a great unwinding, a violent and disorderly reset of the global financial system. When a system becomes this saturated with debt, it does not just gently correct, it snaps. According to Fred Harrison's model, the final winner's curse phase is characterized by a desperate, frenzied attempt to keep the party going. Governments and central banks, terrified of a downturn, do everything in their power to fuel the fire. We see hints of this now as politicians promise tax cuts and subsidies that only feed into higher asset prices. They are trying to defy economic gravity, but gravity always wins. The pop, when it comes, will likely be swift and brutal. It could be triggered by anything: the failure of a major bank, a spike in corporate defaults, a currency crisis. But the trigger itself is almost irrelevant. When a system is this fragile, anything can be the spark that ignites the inferno. The crash would likely be a vicious chain reaction. As asset prices fall, it will trigger the modern equivalent of 1929's margin calls, forcing leveraged players to sell. Companies surviving on cheap debt will be cut off, leading to a wave of bankruptcies. Unemployment will spike. Consumer spending will plummet. And because our system is so interconnected, the crisis will spread like a virus. A meltdown in one market could inflict massive losses on banks in Europe and Asia. A stock market crash will vaporize trillions in retirement savings around the world. And governments, already buried under mountains of debt, will find their options severely constrained. They have already used their primary tools, 0% interest rates and massive money printing, just to get us to this point. This may all sound like doom and gloom. And for the unprepared, it will be. But it is also critical to understand what a crash truly is. Many believe it is the destruction of wealth. It is not. It is a transfer of wealth. It is often said that the next great crash will be the single largest legal transfer of wealth in human history. While that is speculative hyperbole, the principle is sound. Wealth is not destroyed, it simply changes hands. It moves from those who are leveraged and panicked to those who are liquid and patient. Every crisis creates a new class of millionaires. While millions lost everything in the Great Depression, a small group who saw the crash coming and held cash were able to buy up assets, stocks, real estate, entire businesses for pennies on the dollar. Joseph Kennedy, for example, famously exited the stock market before the crash, preserving his fortune, which grew massively as he bought assets during the Depression. Jesse Livermore, one of the greatest traders of all time, reportedly made a fortune by shorting the market during the 1929 crash, though his later career was marked by major losses. This is the great paradox of a crash. It is simultaneously a time of great peril and great opportunity. For the 99% who follow the herd, it will be a financial catastrophe. But for the 1% who understand the cycles and position themselves accordingly, it could be the investment opportunity of a lifetime. The choice of which group you fall into is being made right now. This is not a time for panic. Panic is what the unprepared will do. This is a time for clear-eyed, rational preparation. The strategies used by the wealthy to protect their fortunes during the Great Depression are just as relevant today. The core principle is simple. Prioritize liquidity and prepare to be a buyer when everyone else is a forced seller. Here is a 5-step survival guide based on the timeless lessons of history. First, and most importantly, build your cash reserves. Cash is king in a crisis. When asset prices are collapsing and credit freezes, liquidity is the most valuable commodity on earth. This was the secret of men like Joseph Kennedy in 1929. They sold assets near the top and held cash. This meant they not only avoided the crash, but were in a position to buy prime assets at rock-bottom prices afterward. This means reducing your exposure to overvalued assets and resisting the urge to chase the last leg of a bull market. The goal is not to perfectly time the top, but to ensure you have the financial firepower to survive the downturn and thrive in the aftermath. Second, deleverage your life. Debt is the anchor that will pull you under. The single biggest mistake in 1929 was being over-leveraged. Today, the equivalent is carrying high-interest credit card debt, oversized mortgages, and car loans. If you see a storm approaching, you pay down your debts, especially high-interest consumer debt. Every dollar of debt you pay off today is a dollar of risk removed from your personal balance sheet. Third, hedge your bets and consider your equity exit strategy. The trader Jesse Livermore did not just survive 1929, he profited by short-selling the market. While shorting is a high-risk strategy, the principle of hedging is universal. For most investors, the prudent strategy is to simply reduce exposure. As you see the warning signs, like soaring margin debt, it may be time to trim positions in high-flying stocks and move that capital into cash or safer assets. Remember the goal: preserve your capital. Fourth, prepare to acquire hard assets at the bottom. After the 1929 crash, those who held tangible assets were in a position of power. While the value of stocks was decimated, land, gold, and profitable businesses remained. The Kennedy family fortune was built by buying up real estate in the depths of the Depression. Gold, in particular, has historically served as a safe haven during financial turmoil. It is worth noting that in 1933, the U.S. government, through Executive Order 6102, compelled citizens to turn in most of their gold. While a different context with some exemptions, this historical event underscores the value governments place on gold during a monetary crisis. The 18-year cycle model also suggests that after a crash like the one projected for 2026, there will be a generational buying opportunity in real estate. Fifth, and finally, update your skills and secure your income. In a severe downturn, your most valuable asset is your ability to earn a living. Use this time to reevaluate your job security. Can you acquire new skills that will make you more valuable? Can you develop a side hustle or an alternative income stream? Having multiple sources of income, even if one is small, provides a crucial buffer. The time to look for a lifeboat is before the ship is sinking. This 5-step plan is not about predicting an exact date. It is about building a financial position that can withstand a storm whenever it arrives. It is about shifting your mindset from a speculator to a strategic investor. We are standing at a historic crossroads, and the data points to a chilling possibility. The fragile debt-fueled prosperity we have enjoyed is on borrowed time. We have a global debt bomb of a size never before seen, and we have a cyclical model with a proven track record that is pointing to 2026 as a potential year of reckoning. The echoes of 1929 are all around us, but this time the scale is exponentially larger. The warnings are clear for those willing to see them. The mainstream will likely tell you that everything is fine, right up until the moment it is not. They did it in 1929. They did it in 2008. They will probably do it again, but you now know what they might be missing. You understand the destructive power of leverage and the undeniable rhythm of the 18-year cycle. You have the historical blueprint for what could be coming. This knowledge gives you a choice. You can ignore it and ride the wave over the cliff with everyone else, or you can choose to act, You can prepare. You can position yourself not as a victim of the coming crash, but as a potential beneficiary of the great wealth transfer that follows. The decision is yours, but do not wait. The clock is ticking. If you found this analysis valuable, subscribe for more updates as this story unfolds. And most importantly, share this information. Send it to your friends and family. We have a moral obligation to warn as many people as possible, because in the face of history's next great warning, silence is not an option.